Hi, welcome to valuationpodcast.com, a podcast and video series about all things related to business and valuation. My name is Melissa Gragg, and I provide divorce mediation and valuation services in St. Louis, Missouri. Today, we'll discuss valuations for financial reporting with Mark Zyla. Mark is a valuation expert in Georgia, the managing director of Zyla Valuation Advisors, which is an Atlanta valuation and litigation consulting firm. Mark is also the chairman of the Standards Review Board for the International Valuation Standards Council. He also was the primary author of the education program of the AICPA and the Royal Institute of Chartered Surveyors for the Certified in Entity and Intangible Asset credential. This is the CEIV, which I believe most valuation professionals are aware of, that goes towards certifying valuation experts in valuation for financial reporting purposes. And it's a fairly new credential, but welcome, Mark. How are you today?
Great. I'm doing well. Thank you for inviting me.
Well, this is an awesome topic. And I think that it's actually an area that people may not completely understand, but typically when they need this type of valuation, they are told by other advisors, accountants, attorneys, and such. So if we get started right into it, why would a company need a valuation for financial reporting? Like, what do those words even mean to us?
Sure. It dates back about 20 years or so ago when we had the technology boom, when companies were buying one another and paying millions and billions of dollars for stuff. And under the old accounting rules, they put it into goodwill. And so the Accounting Standards Center, the FASB, took a look at that and said, are they really buying goodwill? Are they buying something? And, as you can imagine, they're buying something. They're buying technology. They're buying domain names. They're buying customer relationships and things like that. So the FASB changed the accounting rules so that when one company buys another company, they have to identify those assets, what they actually bought, and how much they paid for them. And so on their financial statements and their balance sheet after the acquisition, they have to put the values of what they actually bought and what they paid for it. And they incorporate the acquirer incorporates it on their balance sheet.
Okay, so I'm a company and I go buy another company. Do I need to be a publicly held company? Can I be a privately held company? Do I need this for all purposes? And if I buy something?
Yeah, it's all purposes. So there's no big gap, little gap. If you're public or private, the same rules. However, there are some exceptions that the FASB over the years have made for private companies if they decide to elect those exceptions.
Okay. And you said another word that I think people kind of have an opinion about, but goodwill, right? Give it a little bit more. So let's say we buy a company and it's got assets of $1 million. Okay. And we pay $2 million. Kind of walk me through, where does that other million go?
Sure. Yeah. If you think about it, like it's more than just what shows up on the balance sheet. So it's more than just the working capital and the fixed assets. It's intangible assets. It's a workforce. It's the employees. It's intellectual know-how. So all those that additional value is for those specific identified intangible assets. Also, there's typically a piece left over which falls into goodwill, which is value of assets that typically isn't identified, but it might relate to the fact that these assets are combined and they're in place. You don't have to go out and recreate a company or things along those lines that may not be identified but add value to the company.
Well, and I think that's, is this similar when we hear people talk about a purchase price allocation? Like, is this similar? Is this the same process?
Yeah, it's the same concept. Under the old accounting rules, it used to be referred to as a purchase price allocation. Now, it's referred now to as an acquisition method. Basically the same concept. It's that you have a business combination, you paid something for it, so you have to identify what you bought and specific assets and put it on your balance sheet.
Oh, see that? I think that's fairly helpful. And the other thing about this process is that, business owners typically know that this is something that's required, or when do they find out? When does somebody tell them? Because they get all concerned about buying the company and incorporating that acquisition. When does this process come into play?
Yeah, if they've made a lot of acquisitions, they probably have gone through the process previously, so they have an idea of what the process involves and what is needed. If it's a company that doesn't make a lot of acquisitions, oftentimes they may be aware of the concepts, but certainly before they go through their audit process, their auditors are going to mention to them that they need to identify what actually was acquired and measured at fair value. And so they'll either do it themselves, and then that's possible, or if they don't have that expertise, they'll retain an outside expert that specializes in that type of valuation.
And it kind of makes sense from a lot of perspectives, because I think business owners will always say, well, yes, I have this equipment, but like, what about my people? What about, the other stuff? What about me? What about the name that I've built? Things like
Sure.
that. What if there are patents and trademarks? Is that something that can be dealt with within this valuation?
Yeah, those would likely be considered identified intangible assets. So if it adds value, if it can be separated and either sold by itself or in conjunction with other assets, then under the accounting standards, it needs to be valued in a business combination.
This is good. So another area, I think I went ahead of myself, but that's okay. It was good information. So another area that people, I think, kind of understand is if you've done valuations, right, is fair market value.
Mm-hmm.
Okay. And that's the value for a willing buyer, willing seller. But in this, there's actually a concept called fair value. And so how is that different? What does it mean? Is it even important?
Yeah, it's important because it's the standard that's outlined in the accounting standards, ASC 820. And it's when the FASB created the concept of business combinations and accounting for business combinations and identifying the intangible assets and goodwill, residual goodwill, they created a new definition of fair value. So that's how the valuation expert will look at measuring fair value. And one of the distinctive features of fair value within the definition is it's from a market participant standpoint. Mm-hmm. So it's known as an exit notion, not an entrance notion. So it's interesting that to measure fair value, you measure it what the asset can be sold for, not necessarily what you paid for it. So what you paid for it may not necessarily be fair value. It could be, but it may not. So it's important to follow that fair value standard. At the end of the day, compared to fair market value, the concepts are somewhat similar, but the approach is different in how you get to fair value in financial reporting versus fair market value for tax purposes.
And most people may understand, like if they look back at their financials, they may understand book value. Mm-hmm. So is fair value the same as book value?
No, it's different. So book value typically is historical cost of assets that are either amortized or depreciated over time. Fair value is what you could sell those individual assets for currently in the marketplace as of the measurement date. So it might, and it maybe include assets that in a business combination that typically aren't put on the books. So, the intangible assets that we were speaking about earlier, typically internally generated intangible assets don't show up on the acquirer's balance sheet, but just the acquired intangible assets show up.
Well, and that's kind of where you come in and other valuation professionals come in, because if it were just what was on the books, and I think that, people kind of throw around book value and these types of things, but essentially something could have been bought 20 years ago. It could have been fully depreciated. It could have been written off. And so when you're coming in, you're trying to really see what is the value that somebody else would buy this for, not because you bought it 20 years ago for $3 and now it's worth $1 million. Like we're trying to build in what is that difference and how do you calculate it, right?
Yeah. And I think a good way to look at it is just kind of a summary way of looking at it is if you look at the market to book ratio of the S&P 500, for example, currently it's about 3.5 or 4 to 1. So what that's saying is the market's identifying 3 or 4 times the value that's not showing up on the financial statements. Mm-hmm. And so it relates back to what we're speaking about, that the market's identifying both acquired intangible assets, but also internally generated intangible assets, valuing it, but they're not showing up on the book. So book value would certainly understate the value.
And this is kind of a random side thought, but is the reason why we're doing a lot of this type of valuation because more companies are doing asset sales as opposed to stock sales, or does that have anything to do with it?
No, it relates to a business combination. So the legal structure doesn't matter. The important thing to the accounting standard setters and regulators, the SEC, is that they want better information supplied to investors. Mm-hmm. So if you're making acquisitions and paying millions, or in the larger case billions of dollars, the FASB and the SEC want investors to know what you're paying for, mm-hmm. and how much you paid for, how much you think those individual assets are worth, and amortize it so that investors can utilize that information on a going forward basis.
Well, and you talked about and we briefly kind of got started on these intangible assets, if you will. But I think that, really a disconnect from business owners to like what we do in the valuation world is like, well, how do you value them? Like, how do you know what a trademark or a patent or any of these things are worth? Now, how do you look at it in the context of financial reporting? I think would be interesting as well.
Yeah. So next question, if you think about identified intangible assets, it's specific to different sectors or different industries. Mm-hmm. But there are some common ones, things like technology. You mentioned patents earlier. There might be proprietary technology, trade names, customer relationships, non-competition agreements. But it can extend to things like domain names. And depending on the industry, it could be a wide variety of just different types of intangible assets. So it falls under the definition if it can be sold either by itself or monetized in some way, not necessarily sold, but monetized in some way, either by itself or in conjunction with other assets, then it's considered to have value and needs to be measured at fair value. So what the valuation profession has done is taking corporate finance theory and valuation practices for valuing businesses and modifying them to value specific identified intangible assets. So over the last 20 years or so, the profession has created best practices on valuing non-compete agreements, on valuing proprietary technology, customer relationships. And also, since intangible assets have limited lives compared to the assumption that business has a value in perpetuity, there are methods now to value what's the remaining useful life of those intangible assets, because that contributes directly to its fair value.
Right. And what I don't think people also understand is that you are looking individually at these separate kind of pieces, right? Mm-hmm. Separate pieces and valuing them separately, right?
Right. Yeah. Yeah. And there are techniques, to fit it in with the whole pie and the consideration that's being paid, but it's taking total consideration, total value of what was acquired, and then carving it out into individual values for each of the individual assets.
Now, a lot of times when people are talking about financial reporting, and we know that, there are specific terms that we talk about in the profession, but a lot of times people get a little confused. So I'll get a startup company or somebody newer, and they'll be like, oh, I need a valuation, or I need financial reporting, or I need this. But then they say a 409A valuation because I'm dealing with compensate, what is that this, are they talking the right language, or what are they really looking for in that space?
Sure. So in addition to just business combinations and identifying assets for financial reporting, there may be other reasons for fair value measurement of assets for other purposes under the accounting standards that impact financial reporting. One is valuation of stock that's issued as compensation or equity interests that are issued in compensation. So there's a tax reason for that to be valued. There's also financial reporting reasons for those to be valued. So there are valuation techniques that early stage companies who issue, say they issue options to employees or they issue stock to a vendor in lieu of cash consideration. Under the accounting rules, they need to measure that at fair value and place that also, and that flows through the income statement. So rather than cash compensation, it's the equity compensation.
So like if I'm a consultant and a startup contacts me, and we're going to assume I'm not doing valuations, right? Because that's a little bit of a different issue. But and I maybe I'm a doctor and I sit on the executive board, right? Then the startup company could say, well, we don't have a lot of cash, we don't have a lot of money, but we're going to give you stock. And so I think that most of the time we think, oh, okay, just give them some stock. Who cares? But that's when it triggers the 409A to say, okay, well, what was the value of that stock in lieu of compensation, right?
That's right. And so for 409A purposes, they have to measure the fair market value of that consideration. And then for, or compensation. And for financial reporting purposes under ASC 718, they have to measure it at fair value. And that goes through the income statement. And those are really important because if a company, for example, is either acquired or eventually wants to exit through a public offering or through an acquisition by a SPAC, the regulators are going to look closely at that because they want it to be at fair value. So they don't want you under reporting that compensation. So they're going to look at how you actually measure that value and look at it pretty closely.
And these are, like most valuations that we do are complex valuations, but the calculations within these types of reports, I feel like has a lot more assumptions involved and time and research and things like that. Would you agree that these are a little bit, like you have traditional valuations and then you have kind of financial reporting valuations? Do you agree that the complexity is pretty significantly different?
It is, particularly in a sense that, as I mentioned, best practices have developed over the last 20 plus years, that because it's for financial reporting purposes, that it's often used as audit evidence for what is being placed on the financial statements. So if it's used as audit evidence, then the auditors look at it and look at it closely. And so therefore the valuation of the work has to be auditable. So the outside party has to understand why it was done, the assumptions that were used in the process. Typically the process involves the auditor brings on a valuation specialist as part of the audit team. So there's some checks and balances and questions going back and forth between the valuation, the auditor, the audit partner, the client, and their outside valuation expert, just to make sure everybody's comfortable that it got to the right answer.
Well, and in that, part of what we talked about at the very beginning was this credential, right? And you've been heavily involved in this, and this credential is the Certified in Entity and Intangible Asset credential, the CEIV. But if we look at in general, is it necessary to work with somebody who has this credential? Because, or what does that credential involve?
Sure. So the genesis of this credential was concerns by regulators that there was valuation work that's being used as audit evidence that is being put on balance sheets and financial reporting for financial reporting purposes, and investors are relying on that information. So the regulators are looking at it and saying, how do we know this is right? How do we get comfortable that these people have the training, the education, the disciplinary mechanism? If they mess up, how do we get comfortable with all this? So the profession responded to those concerns by a couple of things. They created some work streams and under something that they refer to as a Fair Value Quality Initiative, and eventually developed what's now known as the CEIV, the Certified Entity and Intangible Evaluation. Along with that, they developed a mandatory performance framework that provides guidance to valuation specialists on how much work needs to be done, so that in the public interest, if they're relying on the financial information that is in part based on valuation, outside valuations, that everyone's comfortable that it's done in a best practice kind of manner.
Well, and essentially, I think that, just to summarize, is that there was a lack of consistency, and there was, because a lot of this, we joke in the industry that it's part art and science, and so I think this credential was in order to, and because you're reporting to the investors. So if you don't have some framework, right, it kind of became the Wild West. So I think that it was a helpful, but can people provide this service without the credential?
Oh, absolutely. Yeah. So it's helpful if an individual has that. However, if a person that doesn't have it, it's perfectly fine to perform this work. There's a little bit different process that would go through with the auditors, as far as the auditing kind of comfort level. The auditors have to get comfortable with the person's expertise, but the work that we're doing under the mandatory performance framework, the best practice become a best practice where it's mandatory if you have a CEIV, but still the same standard. The best practices of performing these valuations as promulgated by the AICPA and Appraisal Foundation, for example, are the same. Mm-hmm. So the CEIV credential provides comfort that person has been through some sort of rigor, but that doesn't necessarily prohibit anyone else from doing that work. And a perfect example is management. It's not prohibited from management to do the work themselves if they're qualified to do that and comfortable to do that, and not retain an outside expert. And they may not necessarily have to have the CEIV credential. However, they're going to have to follow the same, since it's audited, they're going to have to have the same quality and same level of review.
Right. Well, and you mentioned a couple different times this concept of mandatory performance framework. So is this like a guideline of I need to spend 10 hours researching and 2 hours talking to people, or is it more loose and in just like kind of a roadmap of how I should, things to consider and such?
Yeah. So if you think about professional standards, there's professional standards related to ethics, just competent ethical behavior that we all follow. Right. There are technical standards. So if you have a credential from NACFA or the AICPA or RICS, you have to follow their own technical standards. Or IVSC is another example of a set of technical standards, or IVS under IVSC. And then there's performance frameworks. And performance frameworks are not how to do something, which falls under the technical standards. It's how much to do. So the idea behind the mandatory performance framework is to assist in the audit process, because it provides a framework for valuation specialists. How much work do you have to do for it to be considered auditable, so that the process is smoother, that management, first of all, is comfortable and management takes responsibility for the work. But then it's clear enough to the auditors that they can follow the assumptions, the methodology, and make a conclusion as whether or not that's reasonable for audit evidence.
Well, and we've talked a lot about the audit too. So typically when you're pulled in, you're going to be an outside valuation firm outside of the auditor, right?
That's correct. Yeah.
And when you come in, but talk to me a little bit, because we've talked about how much is involved in the actual valuation, but there could be, of the whole project, sometimes that could be like 50% of the work. The other 50% could be talking to the auditors, working through the process. Do you see it kind of fall in like 50-50, or do you see 75-25? But, talk to us a little bit about how you have to prove up that audit or that valuation to the auditors.
Yeah. So the process is typically the outside specialist does their work, provides draft analysis to management, talks through it with management so that management gets comfortable and management is able to take responsibility for the assumptions and methodology. They're not the valuation specialists, but they have to have enough basic understanding that they're comfortable with it and able to take responsibility for it. When it comes time for the audit, when the auditors look at the balance sheet, say, okay, where these numbers come from, they say, here's I retained an outside expert. Here are their qualifications. Here's their report. So the report goes to the audit team. The auditor looks at it. Generally, they have some experience with working with management's outside valuation specialists, but they bring in their valuation specialists on their own audit team who goes through. And typically, they have a series of checklists where they go through and compare the work to their checklist. And they may develop questions if there's something that's not clear from the outside expert's report or schedules. And so they give those questions back to management for additional clarification. Some of the questions management can answer. Some of the questions go back to the outside experts. Sometimes you have conference calls and you walk through the issues and you get the auditor comfortable. Or sometimes the auditor will say, look, we don't approach it that way. But we did a shadow calculation. We did it the way we normally do it, and it comes up the same. So we're okay with it. We don't necessarily agree with that assumption or whatever. So it's a process of give and take. And so sometimes it takes 2 or 3 rounds of those questions to get the auditors comfortable. So it can be time consuming at the end of the engagement. It's typically not 50%, but it's not 5%. It's a little bit, somewhere in between, depending on the experience of the auditor and management and so on.
Sure. But it is defending your valuation to some internal auditors that may have some questions and things like that. You briefly mentioned that the business owner would have to take ownership in some of the process. I think that what you were alluding to was the fact that we work with them for projections. We work with them for looking at the future a little bit. And so a lot of times we as valuation people kind of provide a framework for some of that, but then we need the input from the owners to really solidify the assumptions, right?
Yeah, it's that. I mean, that's a very important part of the process because the information that they provide is critical to a robust credible evaluation. Mm-hmm. But it's also for financial reporting purposes. It's also important for management, the business owner, to understand that since it's going on their financial statements and the financial statements are their representation of the financial performance of the company, that they have to take responsibility, even though they haven't hired an outside expert. So it's helpful for both the outside valuation expert and management to have constant communication and make sure management's comfortable with the assumptions, understands the methodology, ask critical questions, perhaps do some sensitivities to see, if they're comfortable with the process, the assumptions, and the conclusions.
Well, and since you obviously have been operating in this area for quite a long time and have significant knowledge, including, helping with curriculum and helping teach, this type of work to new credential holders, how do you see valuations have changed in this financial reporting arena?
Sure. A number of things are going on currently. From the accounting standard setter standpoint, they're looking at how goodwill is tested for impairment. So once the assets are measured at fair value and put on a balance sheet, it doesn't stop there. There are certain steps that management has to take to make sure that those values are still valid. So if they believe there's it's referred to as a triggering event in accounting standards, they believe there's a triggering event that value is no longer reliable, then they have to impair it. And there are various techniques that they have to do. It typically involves fair value measurements. So they'll measure it for impairment. One of them, an important one, is goodwill. And so goodwill, it gets measured regularly, at least once a year or more frequently if there's a triggering event. And so the standards setters are looking at the different tests that they've required to measure whether goodwill is valid. So both the FASB and International Accounting Standards boards are revisiting those standards. So that's one potential change. Another potential change is there's a hybrid system created from this acquisition method. And what I mean by that is, in a business combination, if you're making acquisitions, the company that you acquired, you have to measure their stuff at fair value, but your stuff doesn't get measured at fair value. So you got a hybrid of book and fair value. And so that creates a disconnect. So there's still that piece, if I'm talking about market to book ratio, still that piece, that gap. And so the accounting standard setters are thinking, well, since the economy is kind of shifting more to tech, where they're seeing that being exacerbated. So they're considering projects to say, do we need to measure internally generated tangible assets? And if so, what's that process? So that's maybe down the road, but they're at least talking about that. So that may be another change. Other changes are things we're seeing at the IVSC are ESG is becoming environmental, social, and governance issues in investing and in valuation are becoming more and more important. So as a profession, we're trying to figure out how do you measure those components, because it's not really self-evident. So that's going to change financial reporting. We're seeing, as it relates to ESG, the accounting standard setters are looking at financial reporting requirements for ESG. So that's going to be a change. So there are more and more valuation techniques that are being developed through fair value measurements that can be applied to other types of valuations. So there's a lot that's going on in valuations for financial reporting that impact not only the financial reporting side of it, but also other types of valuations.
Right. And we didn't even get into goodwill impairment or anything like that, because part of the reality of that is that there has to be something that happens. Can you give us just like a very small example of like a triggering event that maybe people would recognize and they'll be like, oh, okay, that's what could happen at that point?
Okay. So yeah, I mean, just just within the last year, right? You're a hotel chain. And this global pandemic, right? You've made acquisitions of other chains, you put it in a goodwill, and all of a sudden you have no customers. And so what does that do to your outlook? How does that change what you thought, what you paid for and what you thought you were getting compared to what actually happened? So that may be, an extreme example, but that may be considered a triggering event, and you would have to look at that and make some adjustments. So things like that. Some of them aren't as clear cut. It may be, your stock price dropped, but your peers that haven't dropped. Why did your stock drop? Is it temporary? Is it not temporary? If it is, then and you have to understand why it did. Then that may cause a write-off of goodwill, because your goodwill is no longer valid.
Yeah. Is it temporary or not temporary would be the global question that we'd like about the pandemic, right?
Exactly.
So one other area that I think is of interest, because I do a fair amount of litigation, is that can you do things in this process to proactively try to avoid litigation or issues with this valuation? And what could be some of those that we could think about?
Yeah, so some of the things that we've seen where companies have gotten in trouble involved where they tried to shortcut. So they didn't follow these processes. And for whatever reason, their auditor may have been okay at the time with it. So I guess proactively is understand that there are accounting standards that the regulators are heavily involved, not only in accounting standards, but heavily involved in the proper measurement of fair value, and that there are best practices that have been designed by the profession. So one way to, just like everything in life, follow the correct procedures. And it's also helpful you have qualified quality outside experts. You have a high quality audit team that understands the fair value measurements, so that are going to ask the tough questions to the outside expert. That the outside expert has the experience for measuring valuations for financial reporting. Have conversations with your outside experts so that you understand and are comfortable with the work that they're doing, that the assumptions that are being made, that the conclusion is reasonable, compared to your expectations. A lot of it's common sense kind of stuff, but if you don't do that, we've seen companies get in trouble for doing that.
Right, and I mean there are some serious costs involved in this process, but the other idea is that you're purchasing a company, like you're investing in the future, and these types of valuations protect you and your company going forward. But I think that, what you've kind of implied and probably would never say, which I'm going to say, is that, in this space of financial reporting, having somebody who, like, I got my credential last week. I got my credential 5 years ago. I got my credential 10 years ago. Mm-hmm. It really is that you need significant experience or an experienced team. In my opinion, this is the Melissa Gragg opinion, but I think that this is very complex work and it is being watched by other governing bodies. And so you really do want a team that understands it, because you as the business owner or even other types of consultants are not going to totally understand the process, right? I mean, I've been through enough and I'm still like, wait, what did that, like it, because it really is like a big puzzle, right? And you have to put all the pieces down before you can even see how it works together. Mm-hmm. And so that's just a little bit, Mark's not going to tell you that, but I'm going to tell you, you need somebody with significant experience in this space.
Yeah, the credential's helpful, but it's really at the end of the day experience and understand the best practices and have worked closely with outside auditors on a variety of occasions, because it's a unique type of give and take, checks and balances kind of system.
Yeah, the credential is kind of a gold standard. The credential, if you have a professional or a team that actually gets the credential, that's even better. Layering it on to experience, I think, is absolutely good. But that experience is pretty important. Yeah. And most people in this space kind of focus in this space. They're not doing a whole bunch of different types of work. They're kind of focused narrowly, not narrowly, because it's a big area. But you did say one more thing that I want to bring up before we talk a little bit about your firm and how people can reach out to you, because we've been very efficient with all of this information. So, but you said something about ESG, or environmental, social, and governance. And it's kind of words that I understand, but I don't really know their impact. So, and you briefly talked about it, but can you tell me just a little bit more about what does this mean to my company?
Sure. Yeah. So, as you can see from business press, popular press, even advertisements now, there is clearly a trend towards businesses to have greater social responsibility. And so there's a debate whether the constituency of businesses is just their shareholders, maximize profits. We don't care what we do to if we're wrecking the world, we just want to maximize profits. Well, that's obviously changing, right? Now it's like, okay, we've got to, we all live together in a place. We need to be good corporate citizens. Mm-hmm. And so there are three broad areas that entails. One is environmental impact, and we've heard about climate change. What's our carbon footprint, for example, right? Another is social, right? Are we inclusive? Do we encourage diversity in our workforce? Do we encourage diversity on our boards, our customers, basically? And then the last is governance. Do we have the proper controls or processes in place that we're good corporate citizens? We're not paying bribes to gain businesses, for is an extreme example. So that's become a focus where now we're seeing investment funds focus on ESG, and some of the rating agencies like Standards and Poor's and those type of agencies have developed ESG, social responsibility criteria to measure companies. So you just can't say, hey, I make electric cars. I'm a good guy versus all the gas guzzlers. Well, maybe you are, maybe you aren't, right? So we have to measure your impact somehow. So there are rating agencies. So that's one thing, and that's kind of starting, but it's not quite there yet. The second aspect is the accountants. What does it mean for financial reporting purposes? So the IASB, the International Accounting Standards Board, is developing a sister board or companion board for just on sustainability issues. And so that the ESG impact is going to be reported on financial statements in some manner, either through disclosures or somehow, so that investors can get a better idea of a company's social responsibility. They just can't tout it on their website, right? It's got to be, an auditor's going to eventually look at it. So the big audit firms are starting to now develop ESG expertise in auditing the claims, right? The attestations. And then the third area is where valuation people play in, and the IVSC is becoming involved in. And that's okay. We take those two other areas. What does it mean in valuation impact? Is there evidence that if a company is socially responsible, does that increase their value, or does it decrease their value? Or how do we measure that on impact? And there's some academic studies that perhaps it may lower cost of capital, it may increase cash flows, but which obviously both have impact on overall conclusion of value. So we're looking to figure out a way how you actually measure the valuation component of ESG, because we're going to start seeing that going forward.
Well, and I mean, I would imagine because of the pandemic, because, all of us have kind of sat back and taken stock of our life, right? And said, okay, we need to do better. We need to be better. How are we going to do things different? Maybe not everybody did that, but I did that, Yeah. And so I can see that this area is going to be very significant in the future. Like, we might need to do another podcast on this, Mark, because this is it's kind of a little bit of a passion for me too, is how do we see and how do we be a part of, companies starting to do things differently. And it's not about the profit and it's not about the bottom line, because quite frankly, we can all make a lot of profit doing certain things. Sure. It's how do we then give back some of it or do something productive, right? And there should be value to that.
Yeah, absolutely. Yeah. And part of the ESG valuation component, to your point, is what if we don't, right? If we don't, then there may not be any value.
Right.
So,
right. Absolutely.
I'd be happy to explore that further with you.
Yeah, no, I think it would be good because, and even just talking about how companies are going to change from this, because it's not only, like companies don't necessarily just make actions that lower profit, right? They're not just going to go out to do it, but they have now an entire population and workforce that is requiring it and saying, you know what, I want some balance. I want to work from home. I want to do these things. I want to see more diversity. I want to see more people that look like me, right? And why don't you have more women or minorities in the board level and the management level and things like that? So I think all of these topics are going to become, they may not be total valuation topics, but I think they are interesting to watch how the world's going to change.
Sure.
So we have given a tremendous amount of information, helpful things for people to know. This is not necessarily my specialty area. And so if people have questions and comments or concerns or, hey, do I need this? Or oh, maybe another professional did this wrong, right? How can they work with you? Tell us about your firm, and we're going to put up some information about how they can contact you while you talk.
Sure. Yeah. We, Zyla Valuation Advisors, we're based in Atlanta, but we do work across the country and then, sometimes in other parts of the world. We have a person here in Atlanta that assists, but I also have a team in Mumbai, India, that is my support staff, so that we just see different types of work all over the world. But we primarily we do a lot of work, as you can imagine, in financial reporting, but we do some litigation, some tax related work as well. But yeah, we work primarily virtually, so like most people these days, and but it's working out really well.
That's awesome. So if people have some questions, do you typically, if they email you or call you, can they just ask you a few questions and then determine how to move forward? Is that a possibility?
Yeah, please do. Feel free to give me a call or email. I'll be happy to talk to you, see if there's a fit or if there's a way we can help you. Because
these are big projects. I mean, these are time-intensive projects. So it's not going to be just somebody, oh, I think I need this. It really does, work with or research some of the practitioners so that you find somebody that's a pretty good fit for you. Mm-hmm. Okay, well, this was awesome. Thank you so much, Mark. And we're going to ask you back for that other topic, the ESG. So we appreciate all your knowledge.
That sounds great.
All right. Thank you.